Hello, I'm Tony Filippone, and today's topic is the best retirement tax saving strategies for Rockford retirees. Many people think that once they retire, they don't really have to worry much about taxes anymore. The truth is, nothing could be further from the truth. So, before I get into some of these best tax saving strategies for retirees, don't forget to check out my video on how to avoid one of the biggest retirement mistakes that most people make. Just look for the link somewhere around here and go check that out. It's about a 10-minute video. You won't be sorry. You'll be glad you checked that out. So, what are the best tax saving strategies for retirees? Well, number one, you got to know where you stand. Where are you today? As a financial advisor, I find that many people are worried about taxes when they really shouldn't be, and yet other people who should be worried about taxes aren't paying enough attention. Why? They really don't know where they stand. So if you haven't saved all that much, then chances are you really don't have a significant tax issues heading into retirement. It's probably not your biggest problem. You might need to focus more on reducing expenses or having some kind of supplemental income that you can look forward to in retirement. But whether you're a good saver or not, you do need to know what taxes are going to look like in retirement. At our firm, Rockford Retirement Planning, we use a special tax map software program to show you exactly where you're at today, and then we can flash forward and play what if scenarios into the future to show you how your tax brackets are going to change. That's really important information to have when trying to plan for your retirement. It helps you to know where to focus your attention. So you got to know where you stand. Number two, you got to practice good tax diversification. Now, most of us know, if we've been saving for 30 or 40 years in a company-sponsored retirement plan, for example, like a 401k, but most of us, a lot of us haven't saved anywhere else, haven't really invested outside of that program. That's a real problem that we see every day. Just like you need to diversify your investments and have different types of holdings, you also need to diversify what kind of tax buckets you save that money in. Hint, having all of your money tax deferred is not generally a good strategy. Now, if you have too much money saved in a 401k or an IRA, you're going to reach a point where the government's going to make you start taking that money out, withdrawing that money, just so that they can collect their taxes on it. They call that a required minimum distribution. At that point, you're going to begin to lose control over your tax situation, and you might wake up feeling like you've made a terrible mistake that no one's warned you about. So instead, it's a good practice to save at least some of your money in different tax buckets, maybe a tax-free bucket, even a taxable bucket. This way, you're going to have multiple places to draw money from that'll each be treated differently for taxes in retirement or being diversified, having tax diversification. Um, Idea number three, you want to start converting some of those tax deferred assets to tax free assets if you haven't done that or started to do that yet. So many people have saved almost exclusively in tax deferred, like 401ks and IRAs, um, then realize that this might be a problem. It's not too late. You can still convert that money into things like a Roth IRA or even into something called a LERP program. For more information on the LERP, I wrote a whole blog article and a video just on the LERP. So make sure you check that out. I'll try to link it somewhere here so you can find that easy. But that would be an option as well. Any other tax advantage investments. It's never too late to tax diversify. You just need a strategy. So you don't have to convert your entire 401k or IRA all at once to, say, a Roth IRA. Oftentimes, the better strategy is to convert a little bit at a time to avoid getting hit with high taxes all in one year. So that would be, something to be well aware of. So number three is start converting. If you haven't started yet, start looking for ways to tax diversify. Number four, understand how Social Security is taxed. Social Security is not taxed the same as your ordinary income or even capital gains. It's taxed based on its own special formula called provisional income. The first step is to understand what the heck does that mean, provisional income. What goes into provisional income? What incomes count? How do they count? And what makes up that formula for provisional income? Once you know what your provisional income is, then a threshold is applied. And basically, what we're saying is if you make over a certain amount, the amount over that threshold then gets added back in. Even your Social Security gets added back in to your income formula as ordinary income. So we really need to understand how that works. The more provisional income you have, the more of your Social Security income will be taxed and the less money you get to keep. So understanding just this one element can be really crucial for retirees, just managing that tax on Social Security. Even if we can get it from the higher threshold down to the lower threshold, can save you a bunch of money. So it's something worth looking at. Number 5, look at all of your options carefully, as some items might be kind of counterintuitive. What do I mean by that? Well, um, for example, you might have heard of municipal bonds and say, well, hey, those are federally tax free. Isn't that a good deal? That's a tax diversification. But did you know that the income that you earn from a municipal bond actually is counted in that provisional income formula? So it's really not tax free because it could cause some of your Social Security to become taxable. Here's another one. A lot of people think, reverse mortgages. Oh, I'd never buy a reverse mortgage, right? But did you know that the income that you can take from that cash that's otherwise sitting idle in your house doing nothing, that income that you can pull out of your home can be removed as an income stream that's completely income tax free and doesn't affect your Social Security. So maybe that's worth a second look, just as an example. Lastly, you need to work with a holistic advisor. So, a lot of people today call themselves financial advisors, but not all financial advisors are created equal. If your advisor works for a big brokerage firm, he may have the firm's interest firmly in mind when he makes recommendations. After all, he does get paid a commission to sell what the firm wants him to sell. If your advisor works for a big bank, the same is true. He or she works for the bank first and foremost and represents the bank's interest. Again, this does not make them bad people. They're not out to hurt you. But often they're good people that are just part of a broken system. If you're trying to figure out what to do with your life savings, you need to be working with an independent fiduciary advisor, even if that's not me. I highly encourage you to seek out and find yourself an independent fiduciary advisor that works for you, not some brokerage firm or bank. If your advisor says they can't help you with tax planning, estate planning, income planning, Social Security optimization, and all they want to talk about is growing your money. Not, don't get me wrong, growing your money is important. But if that's their only concern, you can probably guess what kind of an advisor you have. Make sure you're working with someone who is legally obligated to work for you and put your interests first. Now, if hopefully you found this information helpful, giving you a lot to think about. But if you have not watched my short 10-minute video about one of the biggest mistakes that retirees make, please check that out now. You're going to be glad you did. So thanks again for watching this video. I hope you found it helpful, and let me know if I could be of some help.